Hey there, investors. This is Tyler from Augury Research. Over the next couple of weeks, I want to put together a series of videos that go over the absolute basics of investing. Whether you're a beginner or a little bit more advanced, maybe even an expert, I think these videos could be useful to you. We will be covering everything from valuation to research tactics to bet valuation. In this particular video, we're going to dive into bet valuing 101. This is my personal favorite part of investing, so I hope you enjoy this video and you follow along for the rest of the series. Without further ado, let's jump right into the lesson. So, before we start valuing our bet, we need to understand a simple term. Expected value. This is also known as edge, right? And it's really simple. All it is the dollar reward times the probability of winning minus the dollar risk times the probability of losing, right? And this is your edge. And this is what's going to separate you from the competition. And contrary to popular belief, the stock market really is just this giant casino where you're playing against thousands of other investors or players of the game. Now, we're going to keep it pretty simple in this example, right? Let's say we have a stock trading at $2 a share. Now, we do some math and we value these future cash flows and add back the book value. And we basically say, you know what? This business is worth $5 a share. Okay, so very simply, 5 minus 2, we know that equals 3. Okay, and let's say this particular business has $1 on the balance sheet of cash and no liabilities, minimal cash burn, no cash burn, and we say worst case scenario, we're going to be able to get $1 a share for this business. Okay. And I have stop written here, but that's a relative term. Really what this is at what price am I going to be able to exit the position if I choose to do so? Okay, so we have 2 minus 1, and that equals $1 of risk. Now, for simplicity's sake, we're going to say this particular bet has a 50-50 chance of hitting. We have 50% chance of winning, and we have a 50% chance of losing. Okay, so what we need to do is we need to find the expected value of the reward, right? So dollar reward times the probability. We know that half of 3 is $1.50. And then we need to find the dollar risk times the probability of losing. $1 times 50% equals 50 cents. Okay? So now all we have to do is take our expected value of our reward minus our expected value of our risk. And that's really easy math. Anyone that has passed 7th grade math class can do this stuff. So we know our edge here is $1. Now, because we know our edge, we can then figure out how much we should be allocating to this particular investment, which is so important because investing is a game that's all about allocation. Okay, and before I continue any further, I already know I'm going to get a ton of questions about how do I figure out the probability of the reward and the probability of the risk. And guys, this is exactly why I made this investing journal for you guys. So the reason why this journal is so important is because there's strategies in here that will help you determine what the probability of success or risk is, right? So you go through these different checkpoints, okay? And you say, okay, do I understand the business? And you rate it, okay? If you don't understand the business, that's a risk and you get a low score there. And then you go through all of these. This is your research process. This is a particular strategy. And once you go through this entire checklist, you add up the score and you will know how confident you are in this particular investment, okay? So that's how you get, what your probability is of winning and what your probability is of losing, because you did the research, you did the due diligence, and you're now making an educated bet. So I hope this video helps you guys understand what edge is and why it's so important to investing. If you're making if you're going ahead and you're buying shares of stock without doing this process, you're really just gambling. You're speculating. You're not playing the game the right way, or you're definitely not playing it in an efficient fashion. Because if you overbet, that's a great sin of investing. And if you're underbetting, you're not being as efficient as possible, and you're going to take longer to reach your, financial goals, longer than you need, right? And this game is all about finding mispriced bets. And like I said earlier, the stock market really is this big casino where you're playing against thousands and thousands of other investors. So having a process is so important to this game of investing. So I hope this video kind of helps you guys understand a little bit more about what my process is. And like, I do this before every single investment. I have thousands of these sheets laying around my office, and it's crucial for me to do this. And one of the reasons my returns have been so good is because this process works of finding your edge before entering any trade, and using these strategies in the journal. So in the next video, we'll probably go over exactly how you figure out how much percent of your bankroll to allocate to each idea, right? And that's going to be the Kelly formula. And I get a lot of questions on that as well. So that will be a video in this series, along with, how do we value the business? So make sure you guys stay tuned. If you guys enjoyed this video, if you found it useful, you got some value out of it, be sure to like it, follow the page, subscribe to the channel, and stay tuned for more, okay? So thanks again for watching, and happy trading to everybody.